So I'm going to start slowly. My name is Amelia. I'm heading marketing at Userpilot, and today we have Yazan, our co-founder and CEO from Userpilot, and a bunch of guests from the VC side. So let me do a quick round of intros here. Astasia Mayers, let me know if I'm mispronouncing your name. Astasia, right? Partner at Quiet Capital, and Astasia is leading the enterprise team, leading investments in ML, data infrastructure, open source, developer tools, and security. And she focuses on pre-seed, seed, and Series A startups. Welcome, Astasia. And then we have Carrie tuning in from London. Carrie is an investment manager at Beringea, and she's responsible for sourcing and analyzing new deals, due diligence on potential investments, managing deal execution process, and advising the portfolio companies as well. And she previously led investments in logistics, security, education, and agriculture. At Breed Reply and Mustard Seed. Welcome, Carrie. Then we have Ivan Bercovich, partner at ScOp Ventures. Ivan spent 10 years building GraphIQ, a startup that was then acquired by Amazon, and he built one of the largest knowledge graphs on the product side and developed natural language understanding and generation technology there. Welcome, Ivan. And then we have Roland also joining us from San Francisco, right? And Roland Osborne is an investor at 500 Global and co-founder at Olaric.com. So essentially he's investing in and advising companies for the Global Fund and 500 Global flagship accelerator program based in San Francisco that we at Userpilot also attended at some point in the past. Prior to joining 500, Roland worked in the Balkans and South America advising startup and bringing his previous experience as a co-founder at Olaric on the product side again. Welcome, everyone. So today we're going to be talking about the current situation, funding situation in 2022 from the VC perspective. Yazan will introduce the topic in a bit more detail. The floor is yours.
Thank you, everybody, and thanks for all the participants and the panelists and everybody joining us. So towards the end of last year and beginning of this year, we've seen public SaaS companies such as Amplitude, UiPath, Palantir lose as much as 70% of their value in a matter of months. In fact, this obviously and inevitably trickled down to the private markets, and there's less VC funding today, fewer deals, fewer exits, and we've seen a lot of companies lay off, and tech startups a lot more layoffs by the dozen. And according to Crunchbase, there's 27% less VC funding this year compared to last year. There's 15% less, fewer deals, 16% less exits, and a lot more layoffs, as we said. And I think part of the problem, it seems, or small part of it or a large part, I don't know, is that founders were raising too much money at too high of a valuation. And those are companies that not particularly have a track record of traction, huge seed rounds. Obviously, with that much more money, burn rate goes up, over hiring, and I'll start the conversation. Maybe we can start with Roland here. Why do you think this happened? And why do you think what led VCs to participate in rounds where they knew there was that overvaluation?
Yeah, I mean, I don't know how much we knew. I mean, we did kind of know on our side, but I mean, a piece of this was, kind of unprecedented, just VC funds being raised. Like, there was so much money kind of coming in that this was able to happen. I think there were a few firms, I don't want to name names, that were, happy, kind of preempting, what they saw as, I mean, they had a narrative of how this would become a massive company. These were founders that were also somewhat proven, and they're willing to throw down, very big checks. And so it kind of just, had this effect of speeding up everything kind of in the industry. And so, founders also, I think, saw these deals happening and were willing, were able to kind of peg their valuations to some of these massive valuations, and were willing to hold out. And it actually, collectively had the effect of, them actually getting some of these valuations. And so to play the game, everyone felt like, they had to write bigger checks, or get into higher valuations. Yeah, so I think that's a little bit why. I'm curious what other folks have a different view.
Yeah, I'm happy to jump in as well. I think one of the biggest causes for the higher valuations is actually what was happening in the public markets. We came out of the first segment of COVID. There was strong growth in the public markets. Companies were trading at all-time highs. Zoom had an amazing multiple. Snowflake had an amazing multiple. And what some of the investors started doing was, instead of underwriting to a historical, next 12 months to EV multiple of, somewhere between 8 to 10 for SaaS companies, they were now underwriting to historical highs, 15 or so. This created an illusion of what enduring multiples could be. And so when you're looking at a SaaS company at Series B or later in revenue, you start to justify how it could be bigger than ever before through these multiples. The second thing that happened was, with these companies IPOing, it gave a sense that, we continue to be in the early phases of software adoption. These markets that maybe 5 years ago we thought were 3 to 5 billion are now 15 to 20 billion. I mean, Snowflake came out and said they sell into an $80 billion TAM. That's absolutely massive in software. And so combined with, these higher multiples, assumed larger markets, you saw growth. The final thing I would say, and I think Roland makes a good point of this, people were anchoring pricing to some of the public companies. So a lot of people were thinking, oh man, Snowflake is, an $80 billion company. If this startup who sells a product on top of Snowflake and can get 10% of spend that someone is selling on Snowflake, they can also be 10% of the size of Snowflake. Or let's say you have a widget in Zoom, they can take 5% of that spend. You can be X amount of this publicly traded company. And so that created this illusion that, at least in enterprise software, you could go become an $8 to $10 billion company very easily. This is simply not as accurate as we would have hoped. Historically, most enterprise software companies IPO between 3 and 4 billion. The idea of a unicorn at $1 billion valuation used to be absolutely amazing. Those companies were at 100 million in ARR. I think somewhere in the past 2 years, founders and investors forgot, at the end of the day, you still need to make 100 million ARR, and it needs to be sustainable for the business. And so pushing those things aside had created this intensity of, hey, we need to get into these early stage startups. We're willing to pay up now because it's going to pay dividends later. There's more capital ever before in crossover vehicles, solo GPs, angel investors, because those people were able to raise because the public markets were so big and capital allocators had more money they could spend in their venture instruments than ever before. And so you created this environment where tons of upside, lots of capital, let's go do deals. And, both sides are responsible for thinking about how that was good for some companies and bad for some companies. At the end of the day, we are all people. These are founders that are like, heck yeah, low dilution, lots of money, let's get after it. I need to go build. And then you have investors being like, that's the most amazing company in the world. This will change my career. This will change my firm. So I want both sides of people trying to make magic happen. And unfortunately, with inflation and interest rates, who have a huge impact on how we value publicly traded companies through DCFs, the market has changed. So I'm not saying that we can't get back to a world of these high multiples. I'm very excited about what could happen in 2023 and beyond. But it was definitely an environment where supply and demand and interest created a lot of interest in early stage startups.
Yeah, and I think it's really interesting how it also trickles down. So for companies that are like growth in public markets that are, at 1 billion ARR and still growing 60-70%, which is crazy, I could understand. But for a seed company that doesn't even have a net revenue retention more than 100%, because the public companies, they've got to a point where their NRR is like 130, 140%. A lot of the growth is driven there, but for without mentioning names, a seed company valued at 20, 30, 40x, it just doesn't make a lot of sense, does it, Carrie?
Hey guys, yeah, no, I mean it was definitely a wild year last year, and I think that Astasia and Roland have already made some really important points. And I think the only thing, just to sum it up, I mean, the world of VC is about capturing the upside. You can only sort of lose one times your money, and so most VCs are just trying. It was just a huge amount. It was hugely competitive. I think everybody sort of loss, ratios on terms of the term sheets they were putting out there and able to sort of close and win last year was going up, and that's because of those crossover sort of funds that Astasia was mentioning. So you've still got money to deploy. It's our job to find investments to deploy it into. So we're going to try to sort of hit our investment targets and do that. I mean, there's some argument for should folks have been more disciplined, but I think just like right now, there's conversations where people can't sort of call the bottom of the market. We also weren't really sort of able to call the top of the market, I think, last year either. And again, so for VCs wanting to kind of capture that upside, we kind of didn't want to miss out. But yeah, I mean, I think I wrote some term sheets and I knew it was ridiculously frothy, but it was just the dynamics of the time. And,
was it FOMO?
No. But I think we did all know that it was very toppy, like while it was happening, but we also sort of didn't know when exactly it would sort of end and go away.
Totally. I really like something that Carrie said, which is, our job as investors is to hit home runs and be in the winners. And so when you're particularly thinking about early stage, which is where I focus, early growth, Series B, mezzanine, that's a little different story. But an early stage investor is thinking, how absolutely exceptional is this team? How visionary they're, how big is the market? Once again, going back to my comments about we think markets are bigger than ever before. And what can they execute and build that's going to be a phenomenal product? And so given that we're so focused on the early stage and what it can be, we're willing to take that shot for the upside. If you look at a $400 million fund, typically you have between 25 and 30 investments you make as part of that fund. And usually 3 are the fund returners. Everything else becomes kind of negligible. They may do a little bit of to help your, make return, but it's really the winners. And then over time, you do fund management and back up the truck and give them as much money as possible to move the needle on the fund. So at the early stages, you're looking for those shots on goal and willing to pay up a little bit to make it happen.
Yeah, that's a great point. So going back to the founder's perspective, how do you think they should approach valuations now? Should they think about decreasing burn, taking a down round, Ivan, if you want to chime in.
Sure. Well, first of all, I think, connecting from the previous discussion, there is a certain unavoidability of valuations going up, right? It's something that just happens in the market and not one party or side controls it. But I think it's important to think about sort of like the consequences to that, positive and negative, right? Like the positive consequence probably occurs more at a group level, right? So like the whole cohort of companies that jointly got a lot of capital deployed will produce some interesting results, right? Like among the thousands of companies that receive billions of dollars, some are going to do good stuff. So for example, I'm a non-believer in crypto, but there's been a lot of deployment in crypto. So I'm sure there's going to be some interesting things coming from there. There is negative consequences as well. And I think the negative consequences are more at the individual level, because I think founders lose perspective of what's the point of an investment. The point of an investment is to make money, right? Like that's the whole idea. It's not for me, the founder, to make money. It's for the investor to make money. It sounds silly, but it's very important, because when you think from that perspective, you start thinking like, okay, I spend $1, I need to make at least $1, because someone has to make money at the end. So you raise these monstrous rounds early on. And I've seen founders that you talk to them and they have started to think that investment is actually income as opposed to an investment. Like, oh, I have an investment, I raise more money, I pay myself a bigger salary, I hire more people. This is a source of revenue for us, and we're going to build a company with it. And once cash starts flowing, you realize that you have a company that is not sustainable at all. So I think the most important here, the most important part is you have to be capital efficient. You have to understand, what is the flow of capital coming into the company, and what is the machine, the process, what is the feedback loop that is turning that capital, into more capital. It's nice in SaaS companies because the feedback loop tends to be shorter, but you may be doing some hard tech or consumer and have a different perspective, but you still need to understand, what are the mechanisms that you're going after. And a lot of these business models are well understood. So you should understand the metrics that are typically used to evaluate those models, and convince yourself and convince others that you're producing, real value long term.
And so, how do you think founders should approach valuations right now?
So I think so. Here's the thing: a high valuation is great because you get low dilution and you may get a lot of capital, as long as you feel that you can make it to the next milestone, regardless of the economic conditions, right? So they say that I get 100 times multiple on my company, right? I know that the steady state valuations are going to be closer to, whatever, private equity long-term average is like 7%, 7 times, right? So if I got a valuation at 100 times, I need to grow my revenue 10 times just to earn my existing valuation in the future if the economy were to go back to steady state. If I don't, I'll get a down round. Down rounds are bad. We can expand on that. But I think typically I will look at to what revenue or level of maturity I can get with this current investment, and will that go beyond the next investment milestone, regardless of economic conditions. And I want my investors to make money. I've been an entrepreneur, now I'm an investor, but it's a long-term game. Amazon bought our company. I want Amazon to feel that they made a good purchase. I don't want it to feel like winning the lottery. So I think that mindset, it's not very prevalent today, but it's very, very helpful in building a successful business.
So have we actually seen a significant change in valuation multiples this year compared to last year? Have we actually?
I'm really curious. I mean, is everyone else here in San Francisco, and am I the only one in London? And are we all
In San Francisco?
Yeah.
I think so. I mean, in London at Series, so what I'm hearing is that seed hasn't collapsed as much, but its Series A has, and that at least is from the London perspective. But I don't know if that's the same in sort of the West Coast.
I would say that mezzanine, like walking back from IPO or exit, mezzanine financing is very slow right now because it's completely tied to the public multiples. You go down to like Series C, Series V, investments are still being made at less frequency, but there are healthy rounds happening. We're not seeing the same magnitude of 100x multiples anymore, but they are getting done. You go down to A, we've seen some discounting, usually about 15 to 20%. Let's say you're an amazing business last year who's incredible team, incredible vision, great products and design partners. You were able to raise 20 or so, in and around 100 million posts. That's been walked back a little bit. It's truly for exceptionalism. And then on the seed side, we don't see that much change at all, because once again, often it's pre-product, it's a team, market, and vision bet. And you're trying to believe in the upside and dream the dream with founders.
What would actually be, yeah, sorry.
I guess I guess I do resonate with that mostly. I have seen a little bit of this trickle all the way down to seed personally. And I think some of that is like urgency has been taken away a lot on the investor side. There's a little bit more waiting, and that's pushed certain companies, where they have to take like, a little bit of a different valuation than we would have seen. And we've seen that at the A, but also even with some of these, a couple, pre-seed companies, we've seen kind of come down.
So I'd be curious to know, like, what would be your advice for a company right now that is kind of struggling, doesn't have a lot of runway, what in your portfolio, and they're just not able to raise right now? No advice?
I don't think anyone's jumping in to answer that, because we've seen it, and I think we are seeing it. We've got 44 companies over here in the UK, and it's tough. It's really tough, and we're seeing, if you are in that sort of, if you don't have the runway, then, and you're not unable to raise, then it is just really coming down to really cutting to the bone and layoffs, and you've got to sort of find a way to survive. You kind of go to your existing investors, try to do a bridge round, and we've also seen a couple of things really go under. So it's been a little bit of a tough year. Well, it's that last 6 months, I'd say.
So I have a tough question. Do you think right now that more founders are kind of afraid now from taking the VC route, saying, maybe they'll take a seed, a Series A, and then be like, we'll look for more sustainability, is this something that would concern you?
I think this is a great question. One is, I don't think anyone should take venture capital if they don't want to take venture capital. Like, you have to have an understanding of the relationship, the mission of what you're trying to do. Right. You can build amazing businesses through loans or cash flows you're making off of revenue for your project. This is a certain type of path for building a business. The second part is, you can raise seed and Series A from venture capital and then have such a high flying business that you're churning off cash, and you can continue to build and reinvest that into the company to hire headcount, to continue to hit growth milestones. That's often not the case with companies. Like 95% of companies, when they come out of a Series A and are even doing well, still need an infusion of capital to continue to build at, a high growth level that could eventually get them to an exit. So we are one source, and hopefully it's not just capital. Hopefully your partner is doing more than just wiring you money. They're helping you close candidates. They're helping you with customers. They're helping you think through the go to market, they're helping you bring advisors around the table. So it's I think a little short-sighted to say like venture capitalists only do one thing. It's really like 24/7 support of our founders, rolling up our sleeves to make anything happen. Because sometimes I think founders forget we are super incentivized to, trust me, like we want you to be as successful as possible. Sometimes there's a public narrative of, you know, one party or the other party is the bad guy. But really, if I've invested in your business, I freaking believe in you and I want you to be absolutely massive. So like, I'm going to help you try to get there. And so there, if you have an amazing business that you're doing very well and you don't need to raise any more VC money or don't have the appetite to, because, you know, it does get you on this milestone-based approach to building a business to get that next round of financing. Absolutely don't raise venture. Be very proud of the work that you've done. Be very proud of what you're trying to achieve. There's no like societal pressure to take this route. It's a choice.
I would say
what do you think, Ivan?
Yeah. I mean, I was going to say in public markets, when a company starts buying their own stock back because they have a lot of cash, that's typically considered a bummer, right? I mean, Apple has all this cash and they're buying their own stock. Why? Well, because they have cash in the bank and shareholders are demanding, you know, some of that profit, and so they do buybacks. But what will be much more exciting is for all that money to be reinvested, right? Which is what Amazon did for many, many years. They operated with very thin margins, and that's because they have good ideas of where to put the capital. If you run out of ideas, you put in the bank or do stock buyback. So, you know, the same applies to any company. If you're doing well, no matter how well and profitable you're doing, and I say, hey, I'll give you, you know, a bunch more money at a fair valuation, and you have good ideas, you're going to go and grow even faster, right? So, you know, it depends. Do you have good ideas? Do you know how to apply capital?
I totally agree, especially in SaaS. It's a multi-product play, right? You're just going to keep building more and more products, get that expansion revenue. I'm just trying to play the devil's advocate a little bit, because, you know, VCs have to raise money just like, you know, startups have to raise money. So VCs, that, you know, you know, how long is it going to take for a VC to raise their next round? They probably raise every 2 to 3 years. You're not going to get your portfolio. You're not going to get a lot of actual exits in 2 to 3 years. The way VCs, I would assume, I'm not a VC, but I would assume you're going to show return through that the company you invested in at 10 million just raised around at 50 million. You know, it's not a real return. It is a real return, but it's not an actual cash return, right? So I would assume, as someone who's not from the VC world, that it would make me a little bit worried if more companies would say, like, we're gonna do revenue-based financing. We're gonna try to, you know, stay 2 to 3 more years without VC funding. That was kind of the idea, but I don't know if that was a bit clear.
We get dilution too, Izan. So I mean, we want a fair deal as well, and you know, typically when you have preferred shares, you have pretty strong say on what the next round of financing is going to look like. And so, yeah, I mean, it's nice to have market validation, but you know, even that can be, there is different degrees, right? Like you can have a really credible VC validate you, or you can have a party round, you know, with not much money and a high cap, right? So, you know, if you're just focused on that, you can do something that is actually kind of worthless from that point of view.
Right. Moving on to someone who wants to raise money this year. Are you still looking for the same things you were looking at 12 months ago in terms of, you know, the company itself, the traction they have, the KPIs, or did that kind of change during the past 12 months?
I guess I can jump in. I mean, I think there is more. We're looking closer at at deals, and looking at companies that, I mean, again, we are shooting, shooting for the moon, but we want companies to be in the game long enough that they've got their shot, and so that does require looking a little bit at the metrics where we can. I mean, it's not like we're completely going that way, but compared to last year, there's kind of a doubling down on, we are looking at, net revenue retention and stuff more. But for me, I mean, and maybe this is another question you've lined up, but I'm not just looking at one metric, kind of at the pre-seed stage. I'm looking for the story that you've told of how your business is working is reflected in those metrics, right? So even if it's net revenue retention, I want to look at what's happening with particular cohorts of customers, and does it look like the thing you're saying is working is actually working there. So spending more time diving into those sorts of things than I did probably a year ago, personally.
I would say that there has been a shift for Series A. There's more of an expectation of having revenue at the time of partnership, particularly for infrastructure companies. You can look at, if you're doing an open source play, you can look at downloads and GitHub visibility to see hopefully that there's like double-digit month-over-month growth, as well as how the community is evolving over time. There continues to be less of a need to demonstrate revenue for an open source company at the Series A. For pre-seed and seed, I tend to find that it's still like the market clearing price, because valuation ranges are so small compared to A and B. And what we anchor on is team. Most of the infrastructure investments are, they don't have revenue at the time of partnership. It is, we've done all these amazing customer discovery calls, 40 to 50. We've experienced this pain and heard it from our customers. This is going to be the technical approach that we're going to take to solve this problem. And we're raising to go hire a team to go execute against the vision. For SaaS companies, we see a little bit more revenue than we did in past years at the seed round, but 1 quarter or so is so early that it's still, at least for me and my team, still a team and approach and market bet.
I will say customer diversity is something that we're paying more and more attention. If you have a customer that is 80% of your revenue, that was a risk before, is a higher risk now, where we anticipate more companies will go bankrupt or retract on expenses. So.
Yeah, I think overall, I think it was Roland that mentioned time. I think everyone is just really looking a lot more at the fundamentals, and is the product really need to have, I mean, I got a little bit worried on this, because we are in the innovation, and we're in this because we love technology, and we sort of believe in the sort of power of technology to be so transformative. And I got a tiny bit worried when we were kind of coming into this market sort of in the last 6 months that, there was funding going into all these really interesting areas last year. And then, was there going to be this pullback to enterprise SaaS, which feels sort of that higher margin and more scalable. And, I do hope that there's still sort of appetite out there to sort of fund the really sort of bigger and crazy and innovative stuff that could sort of be making the future. But I do think overall, at least in London, but I think it's worldwide, there's been a little bit of a pullback to those fundamentals. Things like not really just what your contracted revenue is, but sort of what is your actual, revenue. And it's kind of all just getting slightly sort of stricter across the metrics that we're looking at.
Okay, so if we could end it with like one piece of advice that you would give one of your portfolio companies that is right now struggling with longer sales cycles, more indecisiveness, budget cuts for their customers. They're just, sales are slowing down. What would be your advice from the revenue or go-to-market point of view?
I don't know what sort of, obviously it depends where you are and what kind of traction you're having, but I guess my advice would be, obviously everybody says this, but really know and speak to your customer. But I wanted to say sort of turn inward. So kind of really look inward to your product and make sure that it's really delivering value for your customer. And oftentimes if you're running into trouble with sales, it really might not even be your go-to-market. It really might be how valuable, your product really is, how special that product really is. Is it really solving a critical pain point? And it is easier and faster to fix a sales problem and a go-to-market problem than it is to fix a product problem. So really be able to be honest with yourself, with what's going on in the company, and is this a sales issue or is this a product issue? Because product takes longer to do the life cycle development, to do the new releases, to hire the engineers. That's always sort of even more competitive to build up those teams. So I think my advice would first really be able to understand, is it sales or product? Yeah, that's my advice.
I would say change the mindset from capturing revenue to providing value. I mean, similar to what Carrie was saying, but you want to capture, 10% of the value that you are producing for a company, right? So it's really useful when you can think through about, either the savings that you're providing for them or the other growth opportunities, and be able to make a very rational sort of financial decision that if you use this product, especially for SaaS companies, everybody wins. And it's just, again, I think founders over the last 5 years have been accustomed to people will pay for whatever you offer, and it comes down to pushing sales and pushing marketing, and people lose perspective as to whether there is real value here. If your customer were to cut the budget in half, are you the first SaaS company to go or the last one? And I think that's essential, and I think it's a great time to test this. I mean, at the end of the day, a lot of value is going to be created in this churn, because you're constraining, and only the real winners will succeed, right?
I really love the points that Carrie and Ivan made about kind of the knowing that you're creating value and then capturing it, and being honest. I think that, and this is something I actually do when I'm talking to companies, I try to make sure that they understand, like, what metrics are they using to convince themselves that they're doing a good job or that their product is providing value. Like, it's not about downstream VCs or me. I want to know like how they know they're on the right path, because I think that it's easy to, if you're just playing the VC game, to forget about that. And so, yeah, get back to basics and, figure out, like, is your product doing, is it providing the value that you believe, and then focus on the value capture.
Cool. Yeah, I think people make great points. Focus on product first and foremost, listen to your customers. So the other thing is, for the past few years, there's been more flexibility around understanding your entire pipeline funnel, making sure you've instrumented your product with product analytics, your website, and can actually trace how people discover you, and the conversion rate between each step of your funnel, I think, is incredibly important. You may find an opportunity to identify areas of improvement you may also find that through that discovery process, you have rock star SDR and AEs on your team, and you have other people that require additional training and help to get up to speed, and you can make decisions around performance improvement to give you more runway. So definitely understand the data. And I think that can be very clarifying for teams.
Okay, thank you, everybody. Emilia, if you...
Right, yeah, so we have some questions from the audience. Yeah, the other attendees, you can write more questions in the chat window. And in the meantime, an anonymous attendee asked, do you think that vertical SaaS companies outperform others during a recession? Would anyone like to take this?
I would say that, you know, we're big believers in vertical SaaS. We are investors in Procore that did construction management software, and it's a public company now. They did quite well. But people have been doing vertical SaaS for a while now, and I think what you're starting to see is maybe going too narrow to the point that you're building just a feature, and it will be too much of a headache for a buyer. They will have to buy your feature and then another feature and then 2 more SaaS products to do their job. So I think we may have overcorrected a little bit. I mean, I still like the concept of focusing on a vertical in the sense that, you know, both product, domain expertise, and go-to-market sort of like potentiate each other, but don't go so narrow. I mean, don't be afraid to compete a little bit and try to offer a solution that serves, you know, the entire kind of customer base that you're going after.
Totally. I think that's a great point. This is what I think about with vertical SaaS all the time. At the end of the day, you want to be the one-stop shop for your customer with vertical SaaS. That's why MindBody is huge. That's why ServiceTitan is big. That's why ShopMonkey is doing well, is because they do everything end to end. So once again, we talked about listen to your customer, think about the product, what more can you build to be successful? Most vertical SaaS fails because it's way too niche, and then the bigger play in the room add something and, you know, hurts your business. So try to be end to end as much as possible.
Awesome, thank you. Then we have another question from Tariq. What do you think are the most critical internal and external risks due to recession founders should be aware of in 2023?
I think that external is pretty clear, is, you know, budget squeezes, budget freezes. We're starting to hear some teams that are selling into Global 2000 have to get an executive to sign off for a $500,000 contract. That was not the case a while ago. You know, they're going through their own process of understanding the must-have versus the nice-to-have technologies. The second thing is, you know, VC funds will continue to go raise money from LPs. LPs are tied to the public markets. We have a whole bunch of dry powder. It's like, I think 150 billion or so in dry powder for new companies that can continue to change as we deploy that through the next 6 months to a year. So think about how the VC market could change over time. Internally, I think the two things that I'd be focusing on are the people, your employees. What is team culture like? How are they feeling about the business and the opportunity? Make sure that you're communicating consistently and as transparently as possible about what's going on in the business to assure them. Yeah, and pass it along to someone else.
Thank you. Roland, do you have a take on the risks? Anything to add?
I mean, I don't have a ton to add here. I mean, and this might be getting down to the other question, just like recession fear. I mean, I think there's a lot of kind of holding pattern going on here right now. Like plenty of dry powder, but the recession fear is still there, and it is, you know, potentially going to affect, you know, VC funding like downstream. I mean, I've seen kind of companies in the Series B and C are doing a lot to prepare, and this has been advice given to them from investors, to kind of prepare themselves for, difficulty raising over the course of like a 2-year plus kind of horizon. And I don't think, I think there still is some concern about what's going to happen in public markets and on the global stage right now that is, affecting what the fundraising environment is going to be. So it just goes back to kind of what we were talking about earlier. Focus on your product and the things that are within your control, because in the fundraising stage there's a lot that's outside, right? And so yeah, I guess that's my take there.
Great, thank you. And kind of you touched upon the last question that I see here in the Q&A section. From an investor point of view, when do you think this recession fear will fade away?
It didn't even start yet. So
yeah,
what are you talking about?
that's my thought too.
The fear is not going to go away, until actual recession hits.
Yeah, I mean, I think historically, like the boom cycles look to be sort of on the 7 to 8 year cycle, and recessions a little bit more in the 1 to 2 year cycle. So I think for the next 12 months, the fear will be there. I think the US is going to have it less hard than where I am over here in the UK and Europe. But yeah, again, there is just a ton. There's also headlines, that have been coming out. There is still so much dry powder. So I think that there's been a little bit of a freeze up and uncertainty. And there's a lot, like maybe in the investor community, that sort of freeze up happened a little bit early. And then I think that probably those gates will sort of start coming out again towards the end of the year and into next year. I think there's a very sort of strange forces that are really sort of opposing and contrary. It's a really interesting time right now.
I will add that I think people are really pricing uncertainty. Say that we were in a recession, and it's like very clear we're in a recession, and I see a business and they're making money and they're growing. I don't really care that we're in a recession as much. It's the uncertainty. It's like how much further we're going to go down, and that's why the stock market tends to be a leading indicator. Like by the time the stock market flattens, the rest of the economy is going to start doing worse, but the valuations will start picking up again.
Gotcha, that's very insightful. Any more questions from the audience? You can just pop them here in the Q&A section on the right. Oh, there's another one. Do you think LPs are becoming less benevolent with their check sizes? Maybe this was an anonymous attendee. Maybe you could expand a little bit on that. I'm not sure it's entirely clear.
Maybe the question is about how generous they are with their checks, or how much control they want to have of the investments. Sometimes when the economy is more scary, people, even if they want to invest, they still want to have more oversight about what's going on, which is difficult for the governance of a VC. In our fund, in our case, we don't know yet, and I think it hasn't been a lot of time. Just 6 months ago, you could raise a large fund with great terms. So I think it remains to be seen, but you will expect that there will be less capital for investments for sure.
Gotcha, great. I think we don't have any more questions. We're kind of approaching the time. Thank you so much, everyone, for, oh, there is actually one more question on advice for founders. Should companies be raising pricing?
Yes.
That's our only job as investors, is to tell you to raise your prices, actually. Yes. My answer is yes.
That's the advice I heard on SaaSta as well, from multiple talks, actually, that founders typically underprice themselves by like easily 50%.
Yeah, it's scary. Having been a founder and on the other side of this, you know, it's probably some of your own fear driving that, right? Like your identity and your startup and all that is kind of tied in with pricing. And so, yeah, you need someone to tell you to go out a little bit on a limb. And I think you'll be, at the very least, you're going to uncover, you're going to get a new kind of validation from that and understand kind of who your best customers are in that process as well. So it's a good, not only a good way to increase revenue, but to guide your product in the right direction.
Totally. I think we were talking about, like, are you a must-have solution or a nice-have solution? You want to be the vendor that people complain is too expensive, but they're still giving money to at the end of the day. You want to be Snowflake. You want to be Datadog. Everyone complains about pricing. You know, that's awesome. We talked about creating value and extracting some of that value from customers. Like, if you can be the most expensive product in your space and people love you in spite of that, that's pretty badass.
That means you're really the painkiller, right? But I guess this recession fear especially fuels doubts in the founders, especially first-time founders, as to, you know, where they should put the price point. So
it's really, pricing is one of the hardest things to get right. I just wanted to add in a quick comment that also sort of how you structure your contracts can also really help. So I think, you know, inflation linked, it's, you know, some startups sort of don't think to sort of have that in their contracts, but sort of more importantly, for getting someone over the line, if you're kind of going out there a little bit more pricier than you're comfortable with, you could have something like, you know, an opt-out. Sign with us, go with us, we'll get you onboarded, we'll get you sort of all, you know, together on our system, on our platform. And if you don't like it, just leave within 30 days, you know, before the month is over, and you know, no problem. You know, we won't sort of charge you from there. And that's sort of a little bit, I think, more clever and sophisticated than the sort of freemium or try before you buy. So that's just a word to sort of think about how you structure your contracts. Again, depends if these are big enterprise, you know, or, you know, wouldn't apply if you were, you know, selling to lots of tiny little customers. But
that's a very interesting one. Yeah. Awesome. I think we ran out of questions. We're almost running out of time as well. Thank you so much, guys, for joining us today. Yazan, would you like to say anything to conclude today's discussion?
Oh, you put me on the spot. Love it. I think founders should be happy about the current situation, because it's going to really answer the big question. Are they a vitamin or a painkiller? So if you survive the next 12 months, then, you know, you're good to go. So, and if you discover that, you know, you're a vitamin, then this is the time to, and that's the beautiful thing about SaaS, is you can build more products, expand your market, and, you know, so it's a win-win situation.
Never waste a good crisis, right?
Yeah, exactly.
Great. Thank you so much, everyone. We will put the recording on YouTube soon and distribute it for those that couldn't make it live today. Yeah, and hopefully we'll meet again for another discussion in a few months, right? To see if something has changed.
Thanks, everybody.
Have a great rest of your day.
Thank you for having us.
Bye.
thanks for having us. Bye.
Thank you. Bye.